Hello YouTube, this is Alex and this is the simple guide of trading options. And here we'll be covering the part 2 of our series, and this is how to be the casino. Basically, how to trade with the probabilities on your side, or similar to the example that we did in the last video, you'll be the insurance company that sells the insurance instead of the one buying the insurance. So in terms of strategies, we'll be covering why it's better to be the option seller or the option writer rather than the option buyer. And we're gonna show you some studies from TastyTrade. TastyTrade.com is basically a think tank. They are the creators of Sink or Swim, and then they sold it to TD Ameritrade. And then after that, a couple of years ago, pretty new, they made the Tastyworks platform software, which is they have the cheapest commission, so that's why I actually would recommend them. And also they do have a lot of studies that help you understand trading option, and it's completely free in that sense. So the information that they give is completely free. So in this study, they are comparing buying versus selling options, and from using SPY, that's the S&P 500 ETF, 2005 to present, they have showed that historically traders who have bought the infinite upside in the long call have been put at a great disadvantage at the time of entry. So usually when you see people selling courses making 1000% return on your money or things absurd like that, they're trying to sell you buying options. Like, for example, in theory they look good because you said you have limited loss and unlimited profitability, right? And selling options is the other way around. So you have limited profitability and unlimited loss. In theory, that's not completely true, but I'm gonna show it in the in other videos. But in this one, let's talk why it is. And as I mentioned before, we need to put the probabilities in our favor to be able to make money. So when you put a short put, when you're selling a put, let's say we are bullish in a stock. In this case will be the SPY ETF. If we sell, we can get long by selling a put, or buying a call. But to buy a call, you have to spend money, right? And to make money, you need this stock to move more than what you already paid for in the short time that you in the time that you buy the expiration for that option. And when you sell options, it's the other way around. So the time is in your favor. If nothing happens, then you make money. Like when you say average move needed for profit is 0%, and the average move needed for a loss is way more in terms of selling options than buying options. So let's visualize this and actually see it in action. Okay, so here again we are on the Tastyworks platform, and we're using the same example with Microsoft. And let's say we want the stock to go up, right? We think it's gonna go up. We are bullish on Microsoft, so we can either buy a call, and we'll be paying $6.50, or we could sell a put. So let's clear this up. And if I wanted to sell a put, I just go to the put side and click the bid side, and now it's gonna give me the price that what I will be getting. So this is the credit that I will be receiving. So when you see a CR, that's credit. That's my profit. So if nothing happens, I'll keep the $537. And if I want to buy, that's me selling. You see the color red. And if I want to buy, I can clear this and buy the call with this one. So in this software, the good thing about this software also is it's very easy to use. You can drag it, and it's very easy to to manage, and if this is a buy, you can just click here and now it's a sell. But just to make it easier, I just clear it, and again let's buy the call and see how it looks in terms of the probability curve and all that fun stuff. Let's go to the charts. So here we are on TradingView in the Microsoft charts. This is a 4-hour chart, and this is where the current price is at 98.17. This is where it closed. And let's see if we add the trade that we were talking about. So here we are buying a call. We paid $6.50. The strike price is $97.50. So the strike price is right around here, $97.50, right? But we paid $6.50. So in order to make money, we need the price that is right here, right now. You have to go over $6 for us to make money in this amount of time. So we have 54 days to expiration on February 15 of 2019. So if it stays right here, we'll lose all the $6.50, which will mean $650. So we need it to go from here above 6%, basically 6% for us to break even. So we're making zero. We're not losing. So that's, you have to be quite right to make money in this strategy. And most likely, let's say we're gonna be losing money if nothing moves. So from this line below, this is our break-even point, we lose money, and this is how it looks. So you can see that the red zone is where we lose money, and the green zone is where we make money, right? It's not a high probability trade. So actually we can see the probability is going to be 32% to make money in this strategy. So in contrast, if we delete this and buy the same strike and sell the same strike but on the put side, our probabilities improve to 60% instead of the original 30% is now 60%. Let's see how that looks here. We can actually see, we can put them side by side. So this is us buying the call, and this is us selling the put. So this is where the price is right now. You see, we are both in the same line, but because we sold, the price has to go down $5.35 for us to start losing money. So you have to go from here, have to go around 5.5% down before we get to break even. So it goes to 5% over here, and we still break even. So even if it goes 3% or so in this time, we still make money. So remember that even if we are right, let's say it goes up here and we're making money, then it goes down again, and if we didn't close it, then we can easily, with the passage of time, we'll be losing money when we buy the options. But when we sell them, it's the other way around. The passage of time is gonna benefit us because the option will decay. So that's a big difference, right? So here again, let's go back again. We have to go to around 6% for us to break even. Here, if you stay right here, we still make the $535, even if it stays right there. And if it goes down, we just start losing money until we get to the break-even part. So for us to lose in this trade the $650, this has to go $6.50 below. So for us to lose the same amount, the price has to go to 86.32. So 86.32, around here. So the price has to move 13%, almost 14% more for us to lose the same amount of money that we will be losing if the price just stay here, or even if the price moves. We are right, and the price moves, let's say 2% or even 5%. It goes up 5%. If it expires, then we still lose money. But let's say it stays right there, we lose the complete $650. And to lose that here is almost 40% to lose the same amount. So it doesn't make sense. So let's go the other way around. For us to make the $535 here, it can just stay here and we make the $535. But for us to make the $535 here, it has to go above that at expiration, $5 more. So let's go again to the calculation from 104 plus 535 to 109, almost to 110. So at expiration, we needed to go 10% up at expiration for us to win the same amount buying the option that selling the one and just stays, and if it stays just right there. So that's a very simple way to look at it, but it's easier to understand, and that's why it's a higher probability. And that's if we sell it at the money, right? Usually we don't sell the at the money options. We can sell even farther away. So let's see that example. If we sell, instead of selling the at the money, we sell the strike price at $80 strike price. Again, check this out. If you put it right at the price, you can't even see the break even. The break even will be at 78.80 with that same trade. We receive less, of course. We receive only $1 with 20 cents. And let me show you in the trade. Well, doing the strike price will be at the 80. So in this trade, instead of selling this one, we'll be selling this one, right? The 80 strike price. And you can see the probability of profit right now is, if I do this trade, will be 89% probability, almost 90% probability to do this if we do this trade. So that's why it's better to sell options instead of buying. So let's see another back testing, comparing the two strategies. Again, this is using from Tasty Trade. And again, bullish naked option strategies have both been profitable in the last decade. Of course, the last decade have been the market was going up before the end of this year. So if we compare the success rate of the short puts, both are bullish strategies. The success rate is 86%. And if we manage at 50%, so if we, let's say you get $5 in credit and you close it when you're winning $2.50, then you increase your probabilities, but you're decreasing your average profits, of course. And again, you can see here the average profit and loss in the short put is 10 times bigger comparing with the long call when you leave it to expiration. And if you close the long call at 50%, you improve your success rate to 62%, which is a lot better. But again, we were in a bullish environment, so that's important to. So, but let's see, through a bearish trades during that same bullish cycle, what will happen? Again, this means that we were wrong in both. We were short calls, and the success rate was 69%. But when we lost, average profit and loss is minus $8. And but when you compare it with the long put, which is a a bearish strategy in a bull market, then the loss is 10 times bigger. And if we manage the short call, even we were wrong, we still were able to make money. So that's another important thing, that managing trades, even when you're wrong, it can help you make money. So in short, to summarize, we want to sell options. And if you want to be bullish, you think the stock is gonna go up, then we short the put, we short a put option. And if we are bearish, we'll be shorting a call option. So hopefully this gives you more ideas on how to start developing strategies and making money, and why it's so important to just focus on selling options instead of buying, being a premium seller instead of buying options. So in the next video, we will talk more about strategies, specific strategies, and how to make money, and actually how to beat the market. So if you like this kind of videos, don't forget to hit the like button and subscribe, and see you in the next video.